Greetings and thank you for joining us at FutureMoneyTrends.com. I'm here with Christopher Aaron. He's the senior editor for the investment portal Gold Eagle. Precious Metal Intelligence is the flagship investment publication at iGold Advisor. Christopher, thank you for joining us.
Thank you for having me, Daniel.
Well, Christopher, Future Money Trends, the letter, when we invest in mining shares, we get into the fundamentals of gold. And that's why I wanted to have you on the show. I don't want to get into the fundamentals of gold at all. I want to get into where the markets are right now, the trends, how you see where people can make a profitable trade with gold and silver on the paper markets right now. What are the patterns you're seeing for 2017 as a technical analyst?
Yeah, that's a great point. And there's so many places where they discuss the fundamentals, so we don't need to repeat that for most of your listeners. But from a technical basis, this is absolutely, I think, a time that is ripe with potential. If you back out for just a moment, big picture, and you take a look at the gold market from a 40-year perspective, you made that high in 1980 at just over $850 an ounce. And then you came back and consolidated under that level for 28 years. And you had this kind of initial attempt in 2008 to break out from that level, came back down in the crash, and then it successfully broke out in 2009. And so from a technical basis, what I'm seeing, what I'm calling this right now, is a retest of a 29-year basing process. And markets that base for 29 years and then break out successfully to the upside and then retest that breakout point, they do not tend to finish their moves to the upside in 2 years, which is what we saw from 2009 through 2011. So I think for people who understand the potential of, what a long-term basing pattern like that can look like, and the potential for multiple years of gains coming ahead. Of course, this is not going to happen in a linear direction. There are going to be violent corrections in both ways, but I think the potential is very strong here over the next several years. To just get into a little bit of the mining shares. Now, we've had this period of underperformance over the last 5 years or so since the 2011 high. And I have data, let's use, for example, the XAU index of mining shares. This is the index that we have, data going back to 1984. When you look at the ratio of the shares to either the metal itself or to the broad stock market, meaning the S&P 500, this is, by an order of magnitude, about 3 orders of magnitude, the cheapest that these shares have ever been. And we're talking record keeping going back to 1984. And yes, there was a nice move in the 2016 first half, but you're still talking about just basically rounding off of that bottom. So I think for true contrarian-minded investors, although these corrections, man, as we know, they can be 30, 40%, even just over the course of a month or two. I think for real contrarian investors, you've got a sector that cannot go to zero, that is valued the cheapest that it has ever been against some very important metrics.
For the shorter term, just looking at gold last year, it was nice in 2016. You're making higher highs, you're making new 52-week highs. What has been your overall assessment for 2017 patterns?
It looks like we're in a mid-cycle consolidation here in the sector. I would say for gold, you're talking about this consolidation. This is one of the clearest technical battles that I've seen for gold. You can draw a straight trend line down from the 2011 highs to the 2012 highs to all the peaks last year, 2016, including this most recent peak at 1290 just in April. You've got sellers showing up every time the price of gold hits that level. And so, could gold consolidate? Yes, I think it could consolidate seasonally. We have the weakest period for the metals shaping up here for the next 2.5 months. I'm looking at a $330 move from the apex of the consolidation, which is 1205, when that breakout happens. And for full disclosure, we have to say, if we see a move down below 1150 or so, I would tell readers and listeners to be cautious, because that consolidation could break to the downside for one final plunge lower.
It's interesting. If it did make that sort of plunge, would it make a new low, a fresh low?
I think there's a lot of potential here. The setup that I would be looking at would be either a retest or perhaps a new nominal low in the metal itself. And I would expect, if that low is going to form the most significant low of the bear market, I would expect the mining shares to give us strong leading indicators. In other words, they would hold the 2015 lows in December, and we would see an outperformance there, kind of signaling ahead of time that this low in the metal is not going to last.
Are you also using the USD and the Japanese yen for your when you're doing technical analysis for the gold trade?
Yeah, absolutely. Many people have begun to notice this. The Japanese yen especially has had a correlation with gold prices over the last 4 or 5 years, somewhere around 91%. So most of the moves, and the Japanese yen to US dollar cross pair is a multi-trillion-dollar market, so it dwarfs the size of the gold market. So you're seeing strong correlations there. Now, as far as the US dollar, the overall US dollar index, and you're talking an index that is 57% weighted toward the euro, then another 11 or 12% for the yen, another 11% for the British pound. It appears to me that the dollar index as a whole has formed an extremely bearish false breakout pattern from a 9-year advance. So we've seen a 9-year move higher from the 72 level up to just above 100 back in December, January of this year. And that move basically tried to break above that 100 level, held that after the Trump rally. And then we've seen a strong close back below that 100 level. If you look at a long-term chart, that 100 level dates back as resistance back to 2004. So when you see a move like this, where a market is consolidating for a number of years and underneath an important resistance level, and you have sort of a short-term move higher and then a strong reversal lower, this tends to be a signal for a capitulation high in the market. And if that's the case, that would set us up with the thesis for a sustained move higher in the metals over the years to come.
For the mining share specifically, it's just looking at the GDXJ with the rebalance where they haven't done it yet, but they are going to be selling, I think, a net 17 or 18 companies in order to add. But of course, selling creates more selling, and of course, they've attracted the shorts, they've attracted speculators that want to sell these individual stocks, which causes the GDXJ to sell more. And then, just basically selling kind of just snowballs on itself. Do you think for the GDXJ, because of the rebalancing, that it's setting up here for a great buying opportunity?
Yeah, this is an excellent point. You raised a lot of good issues that have been brought up recently with the GDXJ specifically. I was never a huge fan of the overall funds. Owning a basket of 50 or so companies is not the way I tend to like to invest in the sector. I do like to do my own research on companies. That said, I think it's great to look at the GDXJ as an indicator, a leading indicator, and a technical indicator. I think that the fear regarding this rebalancing has reached what I would call an inverse bubble type of mentality. A bubble is something that happens on the upside when everyone is euphoric about an asset, and an inverse bubble is when everyone becomes fearful of an asset class, really against a better logic. And yes, is there selling that is coming into specific equities within the fund? Absolutely. And can some of those fall to a certain extent? And have they? Yes. But I think it's reached a real fever pitch where people are basically discounting that value buyers will exist in the gold space to step in and buy an asset if it's sold below its intrinsic value. So I think value buyers will exist. And if we look at let's look at a sentiment indicator that I follow here, which is the ratio of the GDX to the GDXJ. So we're looking at one divided by the other, and then we're looking at specifically the momentum of that. And just as a backdrop, when the ratio tends to move strongly higher in favor of GDX, this tends to be when investors are scared, and it tends to be times that mark important lows in the sector. So, for example, the last low of this magnitude in the ratio that we saw was in February of 2016. You had extreme moves beginning in the GDX, but you actually had selling coming into the juniors right before the big takeoff. So the low that we see right now, as far as this ratio setting up, the momentum of this ratio and the bearishness toward the juniors versus the seniors is of a similar magnitude to that February 2016 low. I would say that all the signs are there that an important low will be forming, I would say this summer. Of course, that said, we know how volatile the sector can be. It can always move down 10, 20, 30% at the drop of a dime for no other reason than, people get frustrated and sell. So always good to average your way in and use caution over some time.
All right, Christopher Aaron, Precious Metal Intelligence, senior editor of the investment portal for Gold Eagle, and you can catch him on iGold Advisor. If someone wants to email you, do they have access to that on the website under the Contact Us page, or do you have a direct email they can contact you at?
Yeah, I'll give both. There's a tab there, and they can also email me at c.aaron, AARON, at iGoldAdvisor.com.
All right, Christopher, we really appreciate your time. We'll also have your website up in the iTunes and YouTube in the description area. Thanks again for your time.
Thanks so much, Daniel.